We will wait still a minute or so as people are dropping in before we formally start.
Okay.
Okay, let's kick this off. What we have planned today is a look at the uncertainty in the oil market and how specifically American players, US players can exploit that. My name is David Rech. I'm chief economist here at Vortexa and bringing in a background of about 20 years of oil and gas market analysis.
Hello, and my name is Pamela Munger. I'm senior market analyst here at Vortexa, with many years as well in the oil and gas industry.
Okay, so we have planned about a 30-minute session, depending then on Q&A. It may get a little bit longer. You have the ability to ask questions, and we will try as good as we can to answer them. Do this at any point you like. Yeah, this presentation is being recorded, and you will receive the recording as well as the slide pack by email relatively soon after the presentation. Sorry. What we will be looking at, we have basically split the storyline in two segments. We start with the crude markets and look then at the product markets. You may have already had time basically to look here a little bit at what specifically we do plan. So let me kick this off right away with the content. This year evidently is a very interesting one, and the key theme is the recovery from COVID-19. Yeah, the big question mark is, where do we stand in that recovery? There are some people out there who are very optimistic, so to say, and say we are already right now back to the 2019 demand levels, which would be type of a full recovery. I personally have my doubts on that. What we can definitely say on the basis of our data is that in terms of seaborne trade, especially when we talk about crude, we are far away from 2019 levels and from a full recovery. And one way to look at that is basically looking specifically at what OPEC Plus has been doing. And what is interesting there, that even though with April, basically the relaxation of quotas somehow kicked off more in earnest, and then a second step a bit later, you can see that a real increase in exports from that group of countries has actually only happened last month. Yeah? So last month and this month we have a step higher here. I think that's about 1.2 million barrels per day or so, if I remember correctly, and a little bit more perhaps this month, but that's it. Yeah? And you can see where the organization as a whole stood in 2018 and also before COVID struck. So we are still missing a couple of million barrels per day from that point of view. If we look at what is going on at sea, on the sea, taking into consideration all barrels and looking at that from a ton-mile perspective, it's even more striking basically that there isn't really any pickup so far in activity. If you measure it in ton-miles here for VLCCs, Suezmax and Aframaxes, and we're talking here about crude being carried, then of course what comes in as well is the speed, and you can see that the average speed we have on this fleet globally observed is also very low, with high bunker prices being one of the factors playing in there, but also simply the limited demand so far on the fleet and the growing size of that fleet. And yes, there has been a pickup recently in exports from OPEC countries, in particularly also from the US. Now we will come to in a moment. But from an historical perspective, the pickup in freight rates over the last couple of weeks or months is still very, very meager, and much more would have to happen to change this picture. Now let's stick for a moment with OPEC Plus. That's simply very important, because supposedly it's the one group of countries that can add quickly to the supply side of the market. The US may also have a certain potential, but that comes in over time in line with incentives for the players. But there is no real capacity put aside, as you know. Now, when we look at where do these countries stand and where does the contribution come from, we have seen on the slide before, we can see that actually there's a huge divergence between players. So while total OPEC supplies, exports only started to increase as of October, Saudi Arabia and the UAE, as shown in the bars here, did start to supply more to the market already as of July. Yeah, so we have here already 5 months of increasing supplies from these two countries. But that's already largely it. There is one other country group, which is Russia in particular, where you can see they have disappointed a lot, and that over the summer months, and that was the reason why this Saudi and UAE increases did not play through to the market. But as of last month, exports, especially from Russia, to a certain extent also the Caspian countries, have picked up. What is concerning probably as well is that all other Middle Eastern exporters, so that's particularly Iraq and Kuwait, have not really moved a lot in terms of exports. There is a bit of a pickup recently, but if you look where these countries have been exporting before COVID hit, in theory, there should be a lot of capacity. And quickly coming to the final group of countries, that's basically all others led by the African countries. And there you can see that basically the pattern over the course of this year is clearly a declining one rather than an increasing one. And if you look at where we stand at this point of time relative to where these countries have been exporting to markets at the beginning of 2019, then this is a massive about 3 million barrels per day and more loss. On a percentage term, this group of countries here, we are talking about a decline of about 30% versus the 2019 average. And this is basically this chart showing is here something similar, but just relative to the 2019 average to make this clearer. So what we see here is that Saudi Arabia and the UAE are already exporting more than they did in 2019. So you can type of say their cuts have been completely taken back. Together, that's about 500,000 barrels per day more to that period of time they're adding to the market. But they're the only countries in the whole group that are doing that. Yeah, not only in the aggregates, but also on the individual level, no other country is currently exporting more. And we're looking here at the average of October and the first half of November. So no other country is currently exporting more than what was the case in 2019. And the question I would like to raise here is, can there be any other reason realistically than that they simply cannot produce more for these countries not to hiking production? I mean, evidently, every country in this COVID world has the incentive to increase government earnings, and you know there is simply nothing holding them back. Yeah, consuming countries are clearly calling for more oil. The quotas would allow for more oil. OPEC countries are generally producing below these quotas. So the only thing I can take away from that is that probably spare capacity is pretty much limited to Saudi Arabia and the UAE. Russia is an interesting question, but the Russian oil ministers just recently said that they will only reach back to 2019 production levels in 2023-24. Yeah, so that basically also pretty much takes away any hopes of significant spare capacity from the Russian country, at least if you believe that statements, which I would personally tend to do so. So yeah, probably that leaves us with something like 2.5 to maximum 3 million barrels per day of spare capacity, which can be easily or quickly consumed if demand is really to appreciate towards 2019 levels. And if the declines we have seen in so many other markets over here continue. And of course, if there is no sizable comeback from Iran coming in, which is up to everybody's guess.
Thanks, David. Yeah, I'm going to talk about a little bit the United States and how they're able to benefit from the recent increase in demand for light sweet crude barrels. As everyone has likely been following, the refining systems have become a very expensive process, especially to desulfurize your heavier part of the barrel into lighter sulfur products, and due to the need for hydrogen and the expense and the difficulties of getting hydrogen. And although some refineries are better situated than others, globally, that process has become quite expensive. Therefore, you're seeing in larger volumes the world increasing their demand for light sweet crude barrels. You can certainly see in the US, and the first chart here, as the increase is happening. I think this past week, the US hit almost 4 million barrels per day of exports, and those barrels are increasingly, they have been going to Europe. They are starting to increase in their passage to Asia even as well, to supply those refiners, and due to the high diesel crack that we've seen. And with this global demand for light sweet, the next chart really goes to show how those supplies have actually been dwindling throughout the rest of the world. David mentioned limited spare capacity, that you see only Saudi and the UAE really increasing their barrels. Well, those barrels aren't your sweet barrels. You've definitely seen a decrease in Caspian and West Africa in terms of that light sweet medium crude that is so desired currently.
Yeah, and this development we're seeing here over the past, that the US is both importing and exporting more crude, may very well go on. If we look a little bit, sorry, what we're seeing right now in the market is a huge increase in exports, as said, and we looked at here a little bit also where is this going. So we would reckon that in the first half, or actually first 17 days of November, the exports to Europe would even increase a little bit more than where they have already been at pretty high level over recent months. What has been an interesting aspect of the last 4 months is that the exports to Asia have been pretty range bound, but this is currently changing pretty significantly. There are quite a lot of VLCCs on the route to Asia, the suspicion is, I mean, partly this demand is simply there because there is, a need to procure additional barrels, but partly it's in all likelihood also related to the high energy and hydrogen costs. And if we look at European import here on the right-hand charts, we can also see that there is a pretty wide gap opening up this year between the use, and this is including intra-European flows as well, so North Sea barrels and so on, a pretty steep increase in the intake and imports and intake and refineries of the sweet, light sweet quality, while medium sour is more stagnant. Looking at this a little bit into the context of the overall crude procurement level, I think a factor that is difficult to underappreciate at this point of time is how low crude procurement has been into Asia over the last 6 months or so. So we had pretty much consistently in this year a declining trend in crude arrivals in the Asian market. And of course, this was partly related to disappointing demand amid the various COVID waves in different countries. But it was, of course, also massively accompanied by stock draws, especially on the crude side, but also on the product side. And this is something that has to change going forward unless we run into even deeper COVID troubles. And we can actually see that already in November, we see an increase in the arrivals in Asia, a relative solid one. And as we have seen in the previous chart, basically as these are here departures, we can expect a significant increase in sweet crude arrivals in December and also in overall imports in December. So the market dynamics here for the crude market are definitely changing to quite some extent. Now perhaps let me talk a little bit about more about this crude quality arbitrage here and the energy and the hydrogen costs. In a complex refinery, you may have up to I don't know, 8-10% of the crude intake as an energy cost component, and in addition to that, basically you have the issue with the hydrogen costs, and the IEA has come out with a figure of $5 to $6 per barrel for hydrogen costs. So if you add this up, basically in a market environment like in Europe or some of the Asian players that are exposed to pricing similar or close to the LNG input price, that means that there is a tremendous additional cost, a tremendous share of the crude barrel, so to say, that is exposed to this very high costs. And the US in exchange does not have this problem to the same extent. From an historical perspective, US refiners may also see high energy costs, but the gas price in the US is about a fifth or a sixth of the level in the LNG input markets. And that's a huge advantage that we will see play out over the next couple of months. Yeah, so I'm trying to wrap up the crude section with that, just to quickly repeat what I've said. So yes, we finally see supply picking up, especially from Saudi Arabia, Russia, and the UAE. There is also a huge call on US crude over the last couple of weeks with very high pricing, but that clearly appears to be at an unsustainable net rate. Yeah, so either the US imports go also up, or the US exports go down. So basically, there will be more demand for crude and the overall higher levels. So there is still quite some upside being left, in particularly as so much of demand over the last couple of months was actually met from storage. And then there is probably also simply still an upside from a seasonal demand perspective, especially from the power generation segment. This peak winter demand is yet to come. So all this should be pretty bullish for the crude market, and in that context, it's of course very relevant that OPEC spare capacity is so limited. Yeah, I was just talking about high energy and hydrogen costs, which is basically ultimately driving crude intake either away from Asia and Europe, if that is possible. That's only possible at a constrained demand environment, or otherwise we need higher margins, which already then leads us to the next section. But in all this, the US is simply very well positioned to benefit from that by taking the relatively cheaper crudes, by exporting their own crudes at very high levels, at very high prices, and also by running its refining system high. And that lets me pass over to Pamela again.
All right, great. Thank you, David. So as David was referring to, the U.S. has this ability, obviously, to run full out, and we've seen the PADD 3 refineries stumble a bit this year, and then in the last few weeks are sort of ramping up to more of their seasonal norms in terms of runs. Now, this is a focus here on PADD 1 PADD 1 in itself, which has had a lot of refinery rationalization in the last few years, and we've seen, certainly this summer, a large an increase in its dependency for gasoline imports, seaborne imports, especially from Europe. So it really kept European refiners going, I would say, this summer, kind of pulled them out of that pandemic shutdown and was pulling those barrels in. And I think the question has been a lot around is, will that flow continue? And the answer looks to be yes, partially driven by the extremely high gasoline crack we've certainly seen in the Atlantic Basin, given European refiners to run and export. And then also the flip side is that PADD 1 gasoline demand has continued to be very strong, and obviously and stocks are I believe below the 5-year average. So I think that will continue to pull in those gasoline barrels. The next chart actually shows the PADD 1 imports of diesel barrels as well, and this you can see an uptick in the last couple of months. You're seeing barrels come as far as the Middle East. That was for October, so it would have been booked well in advance. We likely will see barrels from the Middle East and Asia slowing and staying within the region because they're having their own strong diesel demand in the region. We've also started to see some Russian barrels that will be coming towards the end of November directly from the Baltics. So PADD 1 continues to depend on these outside non-US sources for gasoline and diesel. Okay, David, next slide.
Yes, sorry. Here we go.
Thank you. Again, just more on this hot diesel market that we've seen, and considering that U.S. and Russia are the largest exporters of diesel, we can definitely see that on this chart on the right here. For a moment, you can see this large uptick in exports from Russia in the U.S. This does take into account days 1 through 15 of November, but comparatively, it does look to be online with sort of the norms of 2019. That could put pressure on the diesel crack. It most likely, it definitely most likely will. Let's see, world diesel arrivals by destination. So in this chart, what we did was we tried to split, kind of that east of Suez, west of Suez look, Atlantic Basin, Pacific Basin, in which you can see the Atlantic Basin really driving strong in terms of their diesel demand. So coming out of COVID first, very low stock environment. But what you can also tell is even though the Pacific Basin, so predominantly Asia, was relatively low for demand for a while, that they've actually started to kind of kick back in here. Yeah. David, did you have anything to add on this one?
No, I would say let's go forward.
Okay. So again, kind of going back to that PADD 3 refineries, definitely very well positioned from a hydrogen cost perspective, and the refineries are now running at a higher capacity. Some of the unplanned outages have been resolved, and they're really quite well positioned for what has been a very strong Atlantic Basin demand for products. on this first chart, you can see the world clean product loadings actually reaching what looks like a several month high. Yeah, and for for all products. I think that yeah, as a refinery, you would want to kind of run it at max capacity now in Pad 3 to help supply the rest of the world. If you're going to basically you have a lot of sellers, I think is what it's saying. From the Latin America side, you can definitely see a large amount still of demand coming from that side of the Atlantic basin, and we continue to we expect that to continue and draw from Pad 3 continuously. During the summer, we noticed as Pad 3 refineries were kind of stumbling, we noticed there was a large enough volume coming out from Asia and the Middle East, both STSing off the coast of West Africa and some direct shipments that were filling in for Pad 3. But we most likely will see that cease as we yeah, okay, thanks. Yeah, I thought we had a chart on that. So here we can see on West Coast Latin America imports by U.S. trading region. So this is separating out the Pad 5 imports into West Coast Latin America. And as you can see, as Pad 5 refineries kind of convert to biorefineries or shut down, that market share has been taken by Pad 3, which is really interesting because then that's going to increase those flows into through the Panama Canal, which is already seeing some congestion. And then this is the line that I was referring to in terms of volumes coming out of Asia and Middle East, and you can already see that dropping. I mean, certainly one piece of it is again that demand in the region for diesel, but also the Pad 3 refineries running now and exporting everything they can.
Plus the local Asian demand that has also picked up over the last couple of months.
Yep. Yeah. Okay. On this chart is just showing the East Coast Latin America. So we just kind of separated it out from East and West Coast, showing diesel imports, again, separating the Pad 3 and Asia and the Middle East. And this chart is interesting because you can see this phenomenon where Latin America was receiving quite a few volumes via STS operations, and this is STS operations predominantly off the coast of West Africa, and now those are really more or less turning into direct shipments.
Yeah, and I think that will be a crucial point for the next couple of months, to what extent Pad 3 can take back market share. It has lost quite significantly in that market over the last 6 months and also beyond that. I would think the chances for that should be good on the arguments brought before, the cost advantages on the feedstock side, on the energy side. Yeah, that should make up for overall good period of time going forward. Wanted to come back quickly to this slide here. I do think that this really includes also a lot of short-term, so to say, reactions to the price spike that has been forming in September, and this reached a culmination in October. And it's really significant, as we have seen in the case of diesel from Russia and the US, but also for other products. We have seen a lot of gasoline coming out of Italy, for example, but also from Singapore, and the stocks in places like Singapore and so on, they're all drawn down pretty much. So basically, it really looks like that most people that could really try to make use of this short-term opportunity to sell into peak prices into the market. How this will go on then from here onwards will depend, of course, on a number of factors, and a crucial factor is simply to what extent this current resurgence on the one hand of COVID-19 waves in Central and Eastern Europe, but also in China, and more specific, more generally speaking, how the Chinese economy is doing, and in line with that also a little bit the global economy. There's certain signs that the petchem segment of the market is not doing that well. So these concerns or these limitations of course also play into this weakening of cracks, and if demand would fall significantly, then this can change, of course, a relative optimistic outlook for the refining industry. But otherwise, I think that there is still a lot in place for further increases and potential even increases beyond the levels we have already seen in terms of refining margins, because at the current refining margins, we would think that they are simply too low for quite a significant number of players to maintain the run levels we have seen over the recent past. Yeah, I mentioned the peak winter demand yet to come, and the good outlook for US refiners, which really benefits from the strength in Latin American market. Perhaps just to make this point here again, if you look at the levels over here for total imports, clean imports into Latin America, they have outpaced the 2019 level already, and that is a pretty unique feature on a global level. Of course, this was driven to a certain extent by power outages, but imports are still holding up pretty well, and I think the outlook here is pretty solid. And Asian refiners may need to focus more on the regional market, and therefore the picture for the US is pretty healthy. Yeah, so that's it with the main presentation. Now we will try to answer questions that have come in. Now, let me start with a question on Saudi production, whether there is further upside to that. Evidently difficult to answer. There should definitely still be some upside for Saudi production, but as said, the fact is also that they're already very close to the higher level of productions they had in the past, and the fact that they have increased their OSBs significantly more aggressively than other Middle Eastern players does point very clearly towards a desire not to give the incentive to its buyers to take in and ask for ever more barrels. So clearly a valid concern. Now, another question I've seen was for whether US exports are going to fall from here forward. I mean, based on the levels of the recent weeks, of course, that's relatively likely, because it's evident that the US is exporting at a rate that goes beyond the sustainable level. That's simply drawing stocks. And with refining margins being healthy, there needs to be some trend change on the net rate. The thing we're trying to point out, and we cannot firmly say this will be the case, but I think there is clearly the possibility that more of the heavier, and in particular the more sour barrels that could be partly from the Middle East, partly from Russia, for example, could head towards the US and free up domestic light sweet crude for those refiners in Europe and Asia that are in the current environment really needing this lighter and sweeter slate. Pam, one question on the gasoline outlook for PET 1. You have been optimistic on that. The question was whether it's really likely that gasoline imports would increase in the near future. Can you say something on that?
Well, it's whether they'll increase, I'm not entirely sure. I think there's a good case that they could stay at these levels or increase, just because stocks are very low, and Colonial seems, that it did just recently export a bunch of gasoline up to Pad 1, but prior to that and other than that, that seems hesitant to do so. though it's been a long time, even with stocks very low. I think you see a lot more driving demand on the road because of COVID. So I think that you could see sustainable seaborne imports.
Thank you. Now I'm switching back to the crude side of things. Chinese crude imports, were evidently very low. That's something I've pointed out in one of the slides, and I've said also that I don't think this is sustainable. China has been drawing stocks pretty strongly. Of course, they have a huge amount of stocks, but I think we can already see now pretty clearly that they're increasing their crude imports. The Asian market has actually shown over the last couple of weeks, its prices have eased now a little bit as well, but the relative strength was most pronounced in the Asian market, and that had to do, of course, also with the cutbacks in exports out of China. Now, what I say that it's a bit cooling picture again is certain concerns again with COVID-19, but generally speaking, Asia should see a continued strong demand and definitely needs more crude than it has bought over the last couple of months. Another question is basically for gas to oil switching or generally diesel fuel oil demand in the winter season. It's basically I can only speculate on that. I would probably be cautious to expect very high levels. There are simply numbers limitations on how easily you can switch from gas to oil. And what should also be taken into consideration is that these estimates are usually done for a 6-month period, and I think one has to be careful with that. I think it's pretty likely that we will have a spike in that consumption in January or February, and that may then be significantly higher for a couple of weeks. But on an average level, I think it's not particularly likely that the additional demand from gas to oil switching will be more than the 500,000 barrels per day that has been widely discussed. Yeah, there was a question on oil on the water. That's a hotly debated topic also internally over the last couple of days and weeks. I think what is pretty clear from what we have shown in this presentation is that exports are going up at numberless places. So we have a strong increase in the US that's targeting the Asian market, so that oil will be on the water a long period of time. There is also another topic, which is floating storage. That's of course interesting in this context, but China still struggles to take in all the barrels they have bought, especially this independent refining sector in Shandong, Shushan in particularly. There are still 13 VLCC waiting out there for unloading, so that is all additional oil on the water. I just looked up the Fortis floating storage in the North Sea. That appears to be close to 6 million barrels per day. That part of that is waiting for a month and more for further moving on. Which brings me to another point I want to add here as well quickly. It is a very specific thing, that nobody, not nobody, but that Fortis struggles so much to get to the market. The point here is that it is a crude that is extremely suitable, particularly suitable for petchem feedstock production, and that is adding a little bit to concerns we're also seeing in other contexts that perhaps the global economy has already slowed to a certain extent to the high price levels and to the pressures from, of course, the continued issue with COVID-19, but also specifically from the repercussions of inflation, of inflationary effects. Other increases in supplies, of course, from the Middle East, and we have clearly seen and shown also on the chart here an increasing import from the Asian market, from the Atlantic Basin, and that's all long-haul barrels. So that's putting an end to this period of extraordinary low levels of oil on the water. Hope that answers that question. Good. I think we can leave it here. I think we managed to get through all the questions. Many thanks for your time and interest. As said, we will send you the slides. Please also feel free to follow our analysis inputs on the website, but also in weekly reports we are providing. Please try to get on the recipient list if you're not yet there, and of course also explore about our ship tracking and other new tools. There is a steady edition of that, with freight pricing being the latest one. Yeah, thank you very much for your time and interest.
Thank you.